Bill, good to see you back again.
Pleasure to be here.
Okay, so a lot of people have said, look, you've seen a rise in oil, you've seen a rise in metals, primarily because of this cold weather. You agree?
To some degree, yes, but we've had a general interest in commodities as a whole. I mean, you can go across the whole spectrum, look at the CRB, the way it's pushed up. Yeah. Commodities as an asset class are in great demand. Oil, of course, is being impacted, natural gas also, by the weather. And I just saw this morning, AccuWeather is predicting that we could have one of the most brutal winters in many, many years. So that will be a driving force. I also think there's a little bit more geopolitical undercurrent than there was. Last year was pretty quiet geopolitically. I think there's a little bit more of that in the market now. You mean with in terms of tensions in Iran and things of that sort? Exactly,
okay.
Exactly. And of course the incidents that we had over the holiday in Detroit and so forth, that all adds to the tension that's there. If you go to an airport now with all the security, you can feel it.
Well, other than being afraid of the cold weather and what it's going to do I mean, afraid maybe is not the right word, but at least for me it is, but is it actually going to disrupt production?
I don't think so at this point. We were in more danger during the hurricane season, certainly. And also, if you look at the supply-demand equations and the 5-year averages of the stocks that we have in crude oil and products, and as well as natural gas, they're at pretty high levels. So there's no shortage as far as that's concerned. I think the market is more anticipating than reflecting the current realities.
Now, one thing, Bill, I know that you mentioned just earlier was that a lot of these large funds, for instance, they have to be in various asset classes. So they've got to be in oil as well as commodities and others.
Absolutely.
So a lot of them will also be affected by new regulations coming on board, including the CFTC saying that they're going to implement new margin requirements. In your view, because you've been in this business for so long, are there any benefits to this?
Well, things have changed compared to what they were 20 years ago. So we do probably need some oversight and a little bit of intervention. But I don't think if they come in, with a hammer and try to make it too difficult, it'll really disrupt trading. And eventually the markets do what they're going to do anyway.
Which would be what? Which
will be good. Oil went way up and then it went way down and now it's going up again. So that the markets do. However, we have had a lot of disruptions. I think they need, as far as position limits are concerned, is to lessen the concentration on the nearbys, and so that positions are spread out over many forward months. That's what we see in the market, these huge contangos and all these positions nearby. That has to be spread out. Margins can be...
What do you mean positions nearby? What do you explain that to us?
In other words, when the trades are done, they're all done in the nearby month, which in case of oil, the front month now is February. You need to have those positions all the way forward to February of next year and even beyond. As far as margins are concerned, you have to have a system of margin where perhaps you would raise margins retroactively if positions go over a certain level. But again, if they make it too tough and if they make it too much of a factor, markets will go elsewhere.
Right, elsewhere meaning where exactly? If they hit it here in the U.S.?
Certainly London. I mean, London has always had a more open atmosphere and been really more commodity-oriented than the U.S. And the regulators there seem to be a little bit less concerned about some of these issues. And I've dealt with the London Metal Exchange for many years, and we've had tightness and situations of disruptions, and they seem to handle it pretty well.
Okay, Bill, good to talk with you, and thanks for stopping by. Bill ONeill at Logic Partners.